October 30th, 2025. On that day, a technical announcement from Bloomberg triggered a countdown that most investors are completely overlooking. They officially released the 2026 target weights for the Bloomberg Commodity Index, a move that effectively signals a massive mandatory reallocation for over $108 billion in assets under management. This is the catalyst for what many call dead money. January 8th, 2026. This isn't happening tomorrow. This is happening right now. In the next 13 minutes, I am going to show you exactly how this $100 billion wave is about to move across the global landscape, shifting from overextended assets into a new class of commodity leaders. You have seen the headlines, but you haven't seen the math. This is the blueprint for the January wave. Let's look at the specific sectors where that capital is actually being structurally directed. To understand this, we have to look behind the curtain at the internal mechanics of the Bloomberg Commodity Index. This isn't a speculative bet. It is a mechanical, rules-based process that rebalances based on a strict 2-to-1 ratio of liquidity and production. The index is composed of 25 exchange-traded contracts, governed by a rigid framework where no single commodity can exceed a 15% cap. This ensures the system remains balanced, but it also creates a necessary reallocation when prices rise significantly above those caps. The allocation limits have been reached, and the rules now dictate a major shift in capital. This isn't about market rumors. This is pattern recognition. We are entering a 3-stage transformation. Phase 1, the structural rebalance. Phase 2, the institutional transition. Phase 3, the emerging commodity leaders. Here is where the technical pressure intensifies. Certain assets are being moved by mandate, not by choice, because the index rules require it. We begin with the great precious metal rebalancing. For years, gold and silver have been the primary beneficiaries of the safety trade, but the very success of these metals has created a technical imbalance that the index must now address. This is what we call mean reversion by mandate. Currently, gold's weight has reached an observed peak of 20.48%, far exceeding the index's tolerance levels. Consequently, it is being adjusted back down toward a target weight of just 14.90%. This isn't a small adjustment. It represents a multi-billion-dollar shift in capital. Silver faces a similar transition. Its target weight is dropping to 3.94%, down significantly from previous observed levels. Reports from institutional sources like Tiger Brokers indicate that silver now faces selling pressure equal to 9% of its total open interest. This capital isn't moving by choice or for profit-taking, but through the necessity of index rules. Historical precedents show us that when the largest holders rebalance simultaneously, the price action is notable. This is a scheduled event, not hidden, just frequently overlooked in mainstream financial news. The clock is ticking for those who view this as a standard market cycle. Go verify this yourself by looking at the mandated weight drops. The evidence suggests a massive volume of physical and paper metal is about to hit the bid at the same time. This is a coordinated institutional shift, and capital is already beginning to migrate from the vault and into the next sector. As the capital leaves the precious metals sector, it is finding a new home in the energy markets, specifically in global benchmarks. This is the energy pivot, and it marks a fundamental shift in how the market views its fuel. Brent crude is officially overtaking WTI in significance within the index. In fact, 2026 marks the lowest WTI weighting in the entire history of the Bloomberg Commodity Index. While industry disclosures indicate a historic shift, the target for Brent has been set at 8.36%, the highest on record. This represents a triad of market forces, production trends, export shifts, and index mandates converging at a single point. Available information paints a clear directional trend. We are seeing a structural preference for global benchmarks over domestic ones. This is the transition from the old guard of American crude into the global standard. The movement is mechanical. The billions of dollars currently sitting in WTI-heavy funds must, by the methodology of the index, migrate toward Brent. This isn't happening because of a change in geopolitics. It is happening because the map of the global energy economy has been redrawn. The shipping container time lapse we see in global trade reflects this reality. The money is moving across the ocean, a reality driven by the mechanics of the rebalance. But while oil and gold are moving, one forgotten commodity is making a historic 21-year comeback. This brings us to Phase 3, the strategic re-entry. For the first time in over 2 decades, the index is welcoming back a player that has been absent. Cocoa is being reintroduced to the BCOM after a 21-year hiatus. This isn't just a symbolic gesture, it is a significant capital injection. The target weight for cocoa is being set at 1.71%. While that may sound small, the implications are substantial. To meet this requirement, the index will facilitate the buying of approximately 22% of the total open interest in the cocoa market. This is an unprecedented concentration of volume. At the same time, we are seeing the rise of industrial metals. Copper weighting is also increasing significantly, moving from 5.37% to a new target of 6.36%. This isn't happening tomorrow. This is happening right now. The reallocation is pulling capital out of overweighted sectors and directing it into softs and industrial metals. The overlooked inventory of these markets is finally being recognized. Copper and cocoa are the new focus points of the commodity index. Public reports make it clear the amount of capital required to fill these new allocations is significant compared to the current available liquidity in these specific niches. This creates a notable supply-demand dynamic. We are looking at a scenario where the largest commodity funds in the world are mandated to enter markets that are already seeing tightening supply. The question is, are you positioned for this re-entry, or will you be on the wrong side of the mandate? These are not just numbers on a screen. They represent institutional flows. The rebalancing window is concentrated between January 8th and January 15th, 2026. This is a scheduled requirement for fund managers. Available information from sources like Chai Predict and Tiger Brokers indicates that the volume of trade during this 8-day window will be significantly higher than standard market activity. This is pattern recognition. When $100 billion moves, it leaves a footprint. And that's when the technical reality takes over. Most retail investors believe the market is always a reflection of immediate value. But in January, the market is a reflection of a spreadsheet. The rules of the index take precedence over the standard flow of the economy. This is the technical reality. I am showing you the gears of the machine. The question is how the market absorbs these moves when the money moves out of traditional safe havens and into these new mandates. The consequences of this shift will be felt across the commodity space. We are looking at a divergence between the Bloomberg Commodity Index and the S&P GSCI. While BCOM is mandating a buy-in for cocoa, other indices may have different requirements. This creates a situation where prices can be influenced by multiple technical mandates simultaneously. The result is heightened volatility. Available disclosures point in a single direction. The traditional stability of the commodity basket is being tested. A significant amount of capital is about to interact with these new mandates. Industry analysts have noted tightening supply in the sectors being bought, and the trend is unmistakable. We are seeing a fragmentation of the commodity market. You can verify this yourself by comparing the official 2026 target weight documents with other major index rebalance schedules. You will see different methodologies colliding in January. This is a structural moment for the index model. The shift in Brent, the reweighting of gold, and the surge into cocoa are creating a massive pattern of institutional movement. So, what is the professional response to this scheduled movement? First, watch the January 8th to January 15th window with precision. This is where the price distortions caused by the rebalance will be at their peak. Historical patterns show that these moves often stabilize by late January as the mandatory buying and selling exhausts itself. Don't be average. Don't wait for confirmation from the mainstream news cycles when the move is already in its final stages. This is not financial advice, but rather pattern recognition based on historical data. Industry disclosures indicate a shift in how professional traders are hedging these dates. and the available information suggests that the best way to navigate this is to watch the volume patterns. Regarding the debate between physical ownership and paper assets, the trend is clear. Those who ignore these mandated windows are often the ones providing liquidity for the professionals. The money is moving and the dates are set. If you are not watching the calendar, you are missing the most important technical event of the quarter. The world is changing and the money is moving. Commodity markets are evolving, and the 2026 rebalance proves that even the most established assets are subject to the rules of the index. The inclusion of cocoa and the shift toward Brent reflect a changing dynamic in the global economy. This is about the fundamental reallocation of institutional wealth. The clock is ticking toward January 8, 2026. I have shown you the blueprint of a $100 billion wave. The evidence is in the data, the dates are firm, and the mandates are set. It is happening right now. The question is where you will be standing when the wave breaks. Will you be the one following the data, or the one surprised by the volatility? The window is closing, and the directional trend remains clear for those paying attention. Subscribe if you want to track the pattern as it develops. This is the way to stay informed on mandated institutional moves. The clock is ticking. Pattern recognition starts here.